Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Robert Kientz from GoldSilverPros. Robert, thank you so much for joining us today.
Thank you for having me on, Elijah.
Rob, I was wondering really about your perspective on what is happening in the metals markets, because what we've been seeing over the last couple of weeks is a lot of negative sentiment, and we've been seeing a decrease in the prices, obviously, to levels we haven't seen in a few years. But you've been reporting on the commitment of traders, which actually you have some optimistic news for us. But your perspective first on just what has been happening in the metals.
So we've had, a fairly broad sell-off as of late of the metals. I would go back to January 1 of the year, though, and know that metals have not sold off near as much as the other markets. So even though we've sold off from the high earlier this year in the metals, the yearly high so far, they're still doing better than other asset classes. And what I'm saying is that in the derivative markets, there's been really a sea change in who's holding shorts on the metals. And so we can definitely talk about that. I think the perspectives of the bullion banks versus the managed money has completely changed, and that's a really bullish sign.
Definitely, it does seem like there has been a fundamental shift when you look at the report. Can you expand on that? Because I know the bullion banks have been net long actually for quite a while now.
Yeah, typically, I would say since I've been studying for about the last 10 plus years and have read other people, such as Harvey Organ, Ed Steer, and others, Ted Butler, who spend a lot of time on the same data. And of course, looking at Nick Laird's side, he has all the data, dating back for quite some time. Diving through all that and studying it, for the first time that I've seen for any length of time, the bullion banks are net long in the silver trade on the derivatives market, and they're net long by about 10,300 contracts. I was looking at that today. The latest traders report came out about 6 days ago. So they're net long in silver, and they've been net long in silver the majority of the month. Now, if that continues and it goes, over 30 days, at that point, I would say that's a concerted effort for the bullion banks to go net long. Of course, who's taking the other side of that trade is the managed money. And the managed money never really takes physical delivery. They just typically do the opposite of what the bullion banks do. And I wanted to point out real quick who the managed money are. As was pointed out to me by my good friend Chris Galizio, who is a money manager and has experience running funds basically in the market. As he explained to me, essentially, in terms of the way that the managed money operates, is a very small portion goes in the metals. So that's why the managed money can always be the foil here, and the bullion banks can always make money on it. Because when you look at managed money, they're representing billions and even trillions of dollars potentially. You're talking the global funds. And so if they just put a little bit of that money into gold and silver and they lose it, it doesn't affect their overall performance that much. So the managed money is this big group of amorphous money managers, financial funds, and the like that trades on the futures market, not to take physical delivery, but essentially to play the prices and to make a little bit of money for the portfolio, but they never go all in. And so the bullion banks do an expert job of managing that trade against, the other positions in the market, and that's how they're able to flip. But I think the long-term consequences of the flip are you no longer have the bullion banks, who some of which have been fined and or have admitted to trading the market at certain times, certain ways, as market makers will do, that them flipping basically says, okay, we're changing the script here. We're one of the market makers. We're going to go long. And to me, that says that they're expecting a bull market. Usually when you have a reversal in this type of derivative type market, which the banks basically dominate, they're the biggest players, it means that they're expecting a flip or a reversal. And so I think that's very bullish in silver. Now in gold, we have something similar going on, although it's not quite there yet. The bullion banks are dropping their shorts very quickly. And essentially at this moment, as I'm looking at the July 19th COT report, they have dropped 19,725 of their gold shorts. And I think that follows a week in which they dropped 16,000. So it's accelerating. So there, it looks as though they're very aggressively getting out of the short trade in gold as well on the derivative market. So this is happening at the same time for both. Silver, of course, leading, gold coming right after. And again, it's the bullion banks. All right. This is what they professionally do. And to me, that says that not only with their house counts, but their wealthy clients and companies they represent have decided to go long the precious metals.
I think that is a significant signal that the big money here is moving long. We have a viewer here saying, is anyone taking advantage of the lower prices? It seems like the banks are.
Yeah, for sure the banks are. And one of the things about my comment in my video earlier about the banks hoarding silver is they're hoarding silver on the derivative market, but we also know that they trade physical silver in their account. JP Morgan, for example, has been known to carry hundreds of millions of ounces of silver. Now, how much of that is dedicated to their clients versus on house account, we don't know, but they've been big players in the market for a very long time. Not only are they big players in the American market, but they've helped the Chinese with the Shanghai Exchange, which is a very physically traded market over in China. So they're involved across the world, you know, in the bullion trade. So it's always a positive sign when they're hoarding the positions and they have an active position in the markets and they're known to hold, you know, over 100 billion ounces of metal, at least that we think. Some people speculating a lot more. So I do think that they could profit from not only their derivative positions, but also their physical positions as well.
So it does seem like the narrative out there also, you know, among the people who follow silver is that one theory out there is that it is being suppressed by the bullion banks and they have very large net short positions, but it seems like that whole situation has flipped. So how could that impact the price going forward?
So what I think is what's going to happen is when I think they're the most dedicated group of traders that play the markets over long cycles and long trends. So if they're going long, more than likely that market's eventually going to go long. Think about it, they're market makers. They have more data to have their house and client data. They look at the macroeconomic. I mean, the trading desk at the big international banks, they study not only the metals, they study all of it. And there's 4 major banks that are involved in the 200 trillion derivative trade here in the US. So yeah, I mean, you could, if you wanted to, you could actively, you know, suppress or increase the price of anything. We're not just talking gold, silver. You could talk about oil. I mean, look at when oil went up to like $140 years ago. It wasn't really all around oil shortages. It was anticipated problems that some of them worked themselves out. And so that was never the real true price. Of course, we saw oil actually bid negative at a point in which there was too much physical oil in the system. So the futures went negative. So you have to remember the futures trade is a bet on what people think is going to happen. But the market makers in these markets, the big banks, have a strong hand in influencing that trade because they take so many positions, not only, like I said, in their house accounts, but on behalf of clients. And these are the same clients that they're advising. So when you see them flip net long on silver derivative positions and aggressively move towards a neutral position in gold, eventually maybe perhaps taking a long position, they're basically saying all of our intelligence is saying this is when the metals are going to reverse. And they can be a little bit early and it's okay. They have deep pockets. The managed money, on the other hand, if you look at them, like I said, it's a big collection of people, the big broad market that wants exposure to gold and silver prices. They don't take physical delivery. Sometimes they could represent merchants and things, but there is a producer and merchant category. So typically it's not, it's just wealthy individuals, hedge fund managers. They don't care about the physical and they don't look at the long-term, basically basics of the market, the fundamentals of the market, supply and demand. So they're not ever considered the smart money. It's not their primary trade. And when you see them get flipped on a position, they take the opposite position of the bullion banks. It's very easy to kind of say, okay, the smart money, you know, that really studies and understands and participates in these markets has gone long. That maybe the money that's not as educated in that, not to offend anybody managed money, but that maybe that's not their primary market. It's not their primary expertise. Yeah, that's why they typically lose. And I think if you look at the trend of the prices versus the positions, the managed money side usually doesn't win that trade over any length of time.
We have another viewer commenting here. They say, we back up the pickup trucks and the banks back up the dump trucks. So I think that was kind of funny there. But what I was thinking of when I read that comment was, over the last couple of years, when we have seen people backing up the truck, we have seen an increase in retail demand for silver. We've seen extreme shortages develop in the physical market, and we're just seeing premiums skyrocket, right? And just a few months ago, when we had Russia invading Ukraine, the demand for precious metals was so strong that here at Miles Franklin, we were pretty much wiped out of sovereign minted coins. You had to order, and it'd be about a month delay until we could actually get that next shipment in. So your perspective on that, with this extra demand from the banks, do you think that'll impact the physical market at all?
Yeah, it does. So what's going on in the physical market is very much Elijah, that people are buying. That's why premiums are up. And I know people get frustrated with premiums because they look at spot price and say, well, that's what you should sell it to me at or close to. But you really have to look at the dynamics of the market. The spot price is set in the derivative market. And again, it's not traded for the physical. Less than 1% of trades, and quite often less than 0.1% are ever settled for physical. The vast majority of that trading is simply gambling on future price. That's what the derivative markets essentially are. Okay, it's a very well-educated, well-participated gambling market, or bettors market. And so, that trade doesn't necessarily reflect the physical supply and demand characteristics. For instance, we know that we're supposed to be about 110 million ounces short of silver this year. That was a prediction last November by the Silver Institute, and I've talked about that many, many times. And it does appear as though we're having physical shortages, because you look at the storage of physical silver on COMEX, and it's been coming off. Not only is it coming out of register, I talk about that all the time. That's the tradable metal, but it's actually coming off. We have less silver available on these COMEX depositories than we had before. So definitely you can see that there is a physical demand, a very real physical demand that the spot market doesn't really reflect, because it's not connected to it that much. When you have very little settlement in a given month, in fact, there's only 6 really active settlement months in gold and silver every year each. So only half the time do you have really the capability to settle in physical, and only a small percentage in those half of the year months really ever settle, and silver or gold ever changes hands. So the spot price really has never been an accurate indicator of real physical supply and demand. It's more what's happening at the retail level, what happens to stockpiles. We know, Elijah, when silver squeeze happened over those 3 days, 110 million ounces came off of the books in the UK and were credited to SLV. And it later came out that the LBMA, which runs that market, said in an official news release that if that had gone another 5, 6, 7 days, they would have been bankrupt out of silver. So we knew back then the LBMA market was leveraged. It had much more trade on it than actual silver. And we know that that's the case at COMEX as well, because it's mostly paper trade, 99.9% of it most of the time. So really, they're disconnected. And what will cause the physical price to go up is when the market says we have a shortage condition, and or that shortage condition can be affected by the perception of risk. Because remember, these are monetary metals, not just commodities. So unlike oil, if you're having geopolitical risk or debt risk or fiat risk or whatever the risk is, people tend to go to safe haven assets like gold and silver. So it's not just the current physical supply and demand of the metals, it's people's perception of whether they'll need those metals in the future. And that, I think, eventually is what's going to change it. And the fact that the bullion banks are the early smart money in tells me that sentiment overall may be changing, because you can look at that as a sentiment indicator. Of course, you need to look at GLD and SLV ETFs and the rest of the ETFs in the complex. That's another indicator. And definitely, from a technical charting perspective, gold and silver are sitting here just ready to go up. So it seems like a lot of things are sort of aligning, Elijah, for the physical market, or for the prices to come up to actually match what we're seeing in the physical market, although it hasn't happened just quite yet.
It does seem like just such a strange dynamic we're seeing in the market right now, where it seems like if there's really a shortage of physical silver, shouldn't that be reflected in the price? But it doesn't seem like it is at all.
It's affected.
We're seeing the price fall. It's
reflected in the premium, and it's affected in availability. So if you look at the retail market, you have the highest premiums on silver on average that we've ever had, that I'm aware of the last 50 years when I looked. So the premium percentages are on a lot of issues of silver, especially government coins in shortage, like maybe Maple Leafs or Eagles. Those get really bid up really high premium. Not only that, but what we call junk silver, which is really constitutional government printed coins that had silver in them, 90 or 40%. Are also almost bid out of the market. Andy Shakeman was on our show last week talking about that. He almost can't find either one of those anymore. So we know that the silver people are going to go to first, that they think is going to be tradable and easily recognizable, is already being swept away. The premiums are very high. I have been hearing from people that I know that sell bullion and buy from wholesalers. I have one friend that buys from 5, and he says it's getting harder to do the big orders. And so he's starting to see bigger orders come in. He's seen $500,000 dollar orders. He's working on even bigger orders than that I can't talk about, I haven't gone through yet. And at the same time, again, Miles Franklin had, Andy came on our show last week and talked about Miles Franklin having that $50 million order from the billionaire in Texas. And I think 900,000 silver eagles and a bunch of gold in there. So there are lots of signs up and down the physical market that there's incredible demand for it now. And I don't know how much above ground has not been rehypothecated over this contract or that contract, because that's not reported. We know not all of the physical available above ground in gold and silver is going to be eligible for people to go buy it. It's held somehow, some way by someone or some entity like an ETF. And so the majority of it's probably not that liquid. And I think that little piece, Elijah, that last part I just said, the majority of that not being liquid, when people may look at the market and think that it is where I think the perception is off on the overall supply of the metals and what can happen very quickly if you have a run, especially in silver, but even in gold.
And for those anticipating that kind of scenario, or those who are just wanting to protect themselves, right? We have a few viewers' questions on what kind of metal to have. There's a lot of different ways to invest in silver, but two questions here. What does Robert think of silver rounds? So those are privately minted items that look like coins, but they don't have a face value. They're privately minted, not made by a government. And then we have another question here. What about collectibles? So, there's the numismatic coins, the semi-numismatic coins. They ask, will they be valued differently in the future if a reset takes place?
Those are awesome questions. I'll start with the round one, because silver rounds, especially if you get them from a recognized mint like the Sunshine Mint or whomever, you can buy them from First Majestic. You can get them from a lot of places. Will have value because they'll be recognized. These big mints that have been coining these rounds for so long, and even the bars, the 1, 5, 10 ounce bars, those will, you will be able to find suitable buyers for those. I do think in terms of certain tax advantage accounts, some of the government minted coins do better. Like if you have an IRA, which you're putting your metals in, there are IRS rules around that. But in general, for most people, if you're talking about the physical, especially in your possession, rounds are a really good way to get a discount on silver, especially if you go with a recognized mint or a dealer, like even, some of the dealers are coming out with their own rounds, and those are becoming well recognized. And the second question, I think, was around, if you can repeat that one.
The collector coins. So
that's right, the
there's
numismatic,
the semi-numismatic coins and the numismatic coins. Semi-numismatic being where the majority of the value comes from the metal content. The numismatic where, it's sometimes multiples of the actual value of the metal.
Yeah, so looking at the numismatic market, or the collectible market, if you will, that's a market in which there are certain coins that have certain value due to the rarity or their historical significance that command a value above the spot price of the metal. So let's say gold is sitting at $1,830 today, somewhere around there, where the market closed at, but the numismatic value may be $2,300. If it's a semi-numismatic, it may be $1,950. So you're getting value above the spot. Why are you getting value above the spot? Well, think about a piece of artwork. If we're selling one of Picasso's works, there's only one Picasso, right? And there are only so many originals of his works. And so it has a collectible value that goes beyond what's in, the paint and the parchment and everything used in the painting. So, and that's true with cars. That's true with antiques. That's true with old houses or landmarks or things that carry significant value to the holder beyond just the metal content. So that's a market in which I have participated. About a third of my overall metals holdings are in numismatics. I don't recommend necessarily that other people do that. I did that. It was a calculated speculation on the value of those coins. And since 2019, when I bought them, I've done very, very well. It's been my best performing asset, to be honest with you. However, I'm going to hold mine, not going to sell them right now, because they're beautiful coins. They're graded coins and sleeves. They're gorgeous. They have historical significance. They're all pre-1933. And pre-1933, just real quickly, for people who don't know, there was basically the gold confiscation by executive order of gold in 1933. A lot of people turned in their gold. A lot of the rest of it went underground. And so those coins were remelted a lot of times into bars. And so it destroyed a lot of the pre-1933, like US gold issuance, for example. So those coins have a specific value because of that significant event, because it's when the president said, turn in your gold, but also because it's now much rarer. And it represents an era of American history in which gold was legal tender. So those, and it also goes as to how beautiful the coins are, the date they were issued, how many are there. I mean, there's a whole lot of factors that go into that. It's a great market to be in if you like collecting things and you like studying things. If you're really just in it to get exposure to the metals as a basic investment, I'd say stay with the bullion. But if you want to expand past that, look at some really beautiful coins and get into a market that's very robust, I would say, yeah, numismatics could be a way to go, but educate yourself before you do it. And last part of that question, I think, was, will it be different for the numismatics? Yes, they'll still have collector value. And in fact, I think that they may get preferential treatment, because think about what wealthy people are going to want to buy. They might buy some bullion, but they're also going to buy some numismatics because it carries tremendous value. It's an easy way to put a lot of value into a small package, even more than the metal content. And so I think that market will flourish quite a bit. And typically numismatics do well when there's a shortage of bullion. People turn to numismatics and they'll go buy them, and it bids up the price. So I think a lot of the factors we're talking about here, Elijah, in the bull market for gold and silver are going to affect numismatics positively. But again, as a general warning, just be aware that there are basically two components of that price to educate yourself on the second one, which is more of a collectible, and just attend some coin shows. And, there are books online for that. And of course, people can reach out to me if they need more information.
I think, yeah, definitely. If people are looking to invest in the collectibles, the semi-numismatics, all that, it's really important to do your research before getting into any of that, because it's definitely a different world than just investing in the physical metal. We have another question here from a viewer, and it kind of gets into, I guess, maybe one of the reasons why gold may be manipulated right now is because it's having a low gold price is definitely good for the US dollar. It shows the strength of the dollar, right? But the question is it in China and Russia's best interests for the gold price to rise substantially?
I think eventually it's in everybody's best interest. And I say that because we are very aware through various reporting of very smart people who watch flows of gold that nothing ever leaves China. And they have their own processing and facilitating that we think that they have thousands of more tons than they're reporting. And we know that there was a report that Russia is storing gold in its sovereign wealth fund, not all of it in the central bank, so they don't have to report it. So we know both Russia and China have both, we know based on the flows, they have a lot more gold than they're officially reporting. Doesn't mean they're lying about the official report, they just stowed it in different places, right? And that there's not necessarily a reporting requirement. So they have it. And when you look at the situation in the West, a lot of that gold has flowed west to east. You've kind of seen those flows occur. But one thing that the BIS did in order to shore up the banking system is it more formally recognized gold, when properly hedged, price hedging, as a high quality liquid asset. Now, it always had been one, because central banks used to hold gold. We did until 1971 when Nixon took us off the gold standard. And so no longer were dollars redeemable for gold. And I think in the 60s, it was, the silver dollars. You couldn't redeem your silver certificates for silver anymore. So we definitely think that we probably have less than we actually think, but we don't know because audit hasn't been done in some time. So it looks as though the BIS is trying to get the central banks to buy more gold and to recapitalize it, because you have China and Russia over here stashing gold away. And the BIS is like, wait a minute, gold has no counterparty risk. It's the ultimate asset. And even though we don't necessarily want people to know that, we're going to release all this regulation around, hey, we want you to have some gold. And so ever since the last crisis, basically since about 2010, the central banks have been net buyers of gold. So everybody's capitalizing their balance sheet, their central bank balance sheets with gold. So yeah, it's going to play a big role in the financial system. I do think China and Russia may have an advantage in terms of gold to, say, currency, have printed. We don't know the official numbers, but certainly something to look out for. And the fact that all this de-dollarization is going on in the economy, and people are starting to use other currencies, including the Chinese and Russian currencies, for trade, especially along the Belt and Road Initiative, there is a lot of pull on those currencies. So you see the de-dollarization, and you see the recapitalization and the official recognition of gold in the banking system, and you see people intentionally underreporting because they're not quite ready, to report what they have. But I think they want the reevaluation to occur whenever this economic mess hits, because there's going to be a tsunami that hits, right? And when it hits, then everybody's going to show their cards in terms of how much gold they have. And they're going to say, hey, we're strong because we have so much gold. And the people that don't have as much gold are going to be less strong, and there's going to be pressure on their fiat currency. So I do think it's in everybody's governmental, sovereign national interest for that gold price to go up, not just yet, I think they still want more of it. And I think they're busy draining all the markets of it if you look at the holdings.
Well, very interesting times. Robert, thank you so much for joining us today. If you could leave with our viewers just some last thoughts. I know it seems like a very interesting environment in the metals, where we're seeing, it seems like the bullion banks going long now. So that's the big news from the COT report. It seems like they've been long for quite a while now. So that does maybe signal a seismic shift going forward. But any last thoughts you'd like to leave with our viewers?
Real quick, just to summarize what you just said, the fundamentals have been screaming gold and silver for a very long time, Elijah. It's now that the technical indicators of the people that trade the big markets are starting to flip as well. And that's why there's a little bit of excitement. Now, could they go back in reverse? Sure. But this kind of move this quick, I just don't see them, flipping positions around just to make some money. They typically don't operate that way. And I would say if you're very frustrated with where gold and silver are, given all the stuff that's going on in the world, I mean, it's just so much going on that's risk. I mean, it's screaming risk everywhere. There's risk everywhere. And people go to the metals and we're not seeing the prices rise, even though the physical demand is so strong. Stay with it, because the markets eventually always win. I'm a believer that the markets always win. No matter what mechanisms are in place to hold that down, eventually you find the truth because the market wins. And there's natural laws around economics. And gold and silver really are emblematic of that more than anything else. And so when the natural laws return and we have a little bit more sanity in the world, that's where you're going to see gold and silver in its rightful place. And it will go, because it always has in the past when these things have happened. So if we just rely on history and know the fundamentals of how things actually work, and we understand the risk in the system, then you don't worry every day about the price movements up and down. You just say, you know what, I'm dollar cost averaging in, I'm taking my position over time, I'm going to secure the metals that I need, and I'm not going to worry about it. And that's the whole point of having them. Don't worry about it every day. It will go where it needs to go when it needs to go there. And the fact that you have it means you did the right thing, because it doesn't do any good, Elijah, to buy insurance the day after your car wreck. You got to get it before you have the car wreck, or it doesn't do any good.
Everyone here should go to goldsilverpros.com. Link is in the description. Check out Robert's work there. Also, our website, libertyandfinance.com. Go there, check it out, subscribe to our newsletter. Robert, just give our viewers a little bit. What is Gold Silver Pros?
So Gold Silver Pros is just educational service. Everything we do is for free. You can go to goldsilverpros.com. Check us out there. Most of our content's on social media. So you can go to Twitter, YouTube, and so on and so forth, and you'll find us there. Just do a Google search, Gold Silver Pros, and you'll find us there as well.
All right. Links in the description to all of that. Robert, thank you once again for joining us today, and God bless.
Thank you so much.